your clients in the correct risk profile. So, if you have a client who falls in that, moderate risk bucket, 50-50, 60-40, we don't necessarily think you should move them out. What we're going to be doing in those portfolios is reallocating how we see fit. So, for example, we think equity returns and risk asset returns are going to be much more muted going forward. 2017 was a near perfect year for risk assets. Everything went up. So we think returns will be more muted, not necessarily negative. So we're not completely pulling back off of risk, but what we have seen is, in light of rising rates, we do think it makes a little bit more sense to take some of that equity exposure off the table, because in a world of higher interest rates, fixed income just looks more attractive than it had been. So I think that's probably the biggest change that we've made in our portfolio in light of this market environment.
I'm happy to jump in too. I agree with what Amanda said. Regardless of the market environment, you should stay true to your stated risk tolerance and rely on firms such as Brinker, BlackRock, Frontier, and Sage to allocate your portfolio to the opportunities which it presents. Specifically within Brinker Capital, we're currently managing our portfolios, really in response to the increased market volatility. So at the end of last year, we really reallocated our portfolios, and the position has really worked out well. A great example is we've seen, particularly in the fixed income market, increased volatility with interest rates surging in the first couple months of the year. And within destinations, what we have done is, we positioned for that. We're underweight duration. We favor credit risk over interest rate risk, and we also allocate a portion of our fixed income exposure to lower volatility absolute return, which has done well because these strategies can really have a better tool set to navigate more volatile markets. They can use derivatives, shorts, and other types of hedging products to really navigate rising interest rate environments. So to give an example, the first quarter this year, the Bloomberg Barclays US Ag was down about 1.5%, and our lower volatility absolute return exposure in the destinations portfolios was up 2%.
I'll add a few comments because it's a good place after talking about fixed income. I'll just give you two. Such a softball question, by the way, just what's going to happen the next year. I'll add two quick suggestions, maybe. If there's anywhere you're going to be more, I've already said I think it's a good time to be more active and tactical. If there's any spot in your portfolio, I would say it's the fixed income. I have a chart, and I'll be happy to send it to anyone if it's compliant approved at some point. I call it the crocodile mouth, and that's the interest rate risk in these indices on the fixed income side. The duration has gone up. It's going to be more painful when rates move. And the yield, versus 10 years ago, to get a third of the yield. That crocodile mouth is going to close. Maybe it's not going to close quick, it's going to close slowly. So you do what she just referenced about protecting downside in the fixed income market. So I think you need to be active on the fixed income market, and that's something you need to be preaching to your client. And the second thing is international diversification. After a US dominated bull market for the better part of 9 years, the US market is further along in the cycle than a lot of parts of the world. The US market is more expensive than a lot of part of the world. Doesn't mean you have to dive in, and regionally it's going to be, you got to be particular what region you go, but I think international diversification, active on the fixed, is two big broad suggestions I can give you. I can give you exact positioning, but we're tactical. So what if I tell you exactly where we are, and a month from now we're different? So I'll just give you those two big broad suggestions.
I'll give you 2 points, and then hopefully we give one more before the end. So 2 points. One is we're agnostic between active and passive. We do use mutual funds, but on the passive side we use index funds, which if you compare costs, are apples to apples. So we're agnostic. We don't care if we use an index fund or an active manager. We prefer active managers if they're giving us what we want. But we do have quite a bit of assets in index funds. So that being said, I think that was the question in itself was ETF index versus non. The second piece is risk management. Again, we're looking at it from an asset class basis. Where we can get the most upside long term for a set level of down per portfolio. So we just want you to be comfortable, or your clients to be comfortable in whatever they choose. Right, and 95% of the time we're going to stay in the risk budget that we assign that particular portfolio. If you look at the history of 1 year rolling of each one of our strategies, 95% of the time we have stayed in the risk budget assigned to the portfolio. So the consistency of of risk management is there, right? There's consistency is there. So I'd say the answer, if I understood your question right, between active and passive on the underlying investment, we're agnostic to it, and when it comes down to the risk management of the overall strategy, that's where we start, is downside focus first. That's what we're focused on, is trying to make sure that you're in the right risks for your long-term goals, but also not more than you're comfortable with taking.
Thank you. It's a great market update, by the way.